Chapter 6 Retirement or Death of a Partner. 1. Introduction. Retirement of a partner means retiring as a partner from a firm. As per Indian Partnership Act 1932, when a partner retires from a firm for any reason or a partner dies, the partnership ends but the firm is not dissolved. Remaining partners can continue the firm and its business. For this purpose, necessary accounting treatments of retirement are required to be given in the books of the firm. In this situation, a partnership is reconstituted, that is, reconstructed. 2. Circumstances of retirement of a partner. The circumstances of retirement of a partner can be divided into two parts. A. As per Indian Partnership Act. B. Voluntary retirement of a partner due to his personal reasons. A. As per Indian Partnership Act. As per Indian Partnership Act, partner can retire from the firm due to any of following reasons. 1. Unanimously. Any partner can retire by unanimous consent of all the partners. 2. By notice. A partner has right to retire from the firm by giving notice to other partners in writing, indicating his intention of retirement from the firm. 3. By contract. Any partner can retire as per the conditions of the partnership deed. 4. Insolvency of a partner. A partnership of any partner ends from the date from which he is declared insolvent. 5. Death of a partner. Partnership ends automatically due to the death of a partner. 6. Expulsion by other partners. Subject to provision in partnership deed, a partner can be expelled by other partners. B. Voluntary retirement of a partner due to his personal reasons. A partner can decide to retire from the partnership due to his personal reasons. An active partner is required to give public notice regarding his retirement, otherwise he is responsible for the liabilities towards third parties arising from the activities after his retirement. 3. Important accounting aspects and accounting treatments. Following accounting aspects and accounting treatments are required to be taken into consideration when on the date of retirement a partner retires or dies and remaining partners decide to continue the business of the firm. 1. Calculation of new profit-loss sharing ratio and calculation of gaining share of continuing partners. 2. Valuation of goodwill and its accounting treatment. 3. Revaluation of assets and liabilities. 4. Distribution of accumulated reserves and balance of undistributed profits and losses. 5. Determination of amount payable to the retiring or deceased partner. 6. Payment of amount due to the retiring or deceased partner. 4. Calculation of new profit and loss sharing ratio and gaining ratio. When a partner retires or dies and the remaining partners continue the business of the firm, the new ratio of continuing partners is decided. The same way, the profit share of the retiring partner is distributed between the continuing partners. Consequently, the gaining share of the continuing partners comes into existence. Now, let us understand how the new profit sharing ratio and the gaining ratio is calculated. Calculation of new profit-loss sharing ratio. Due to the retirement of a partner, his profit share is distributed among the remaining continuing partners and therefore they are benefited in terms of profit share. Hence, it becomes necessary to calculate the new profit-loss sharing ratio of the remaining partners. New share of continuing partners is obtained by adding their gain to their old share. Therefore, new share is equals to old share plus gain and gain is equals to new share minus old share. New profit-loss sharing ratio can be calculated as per the following circumstances. 1. When gaining ratio or gain is not given, means old ratio is continued. 2. When gaining share of continuing partners is given. 3. When gaining ratio of continuing partners is given. 4. When old and new profit and loss sharing ratio are given. Now, let us discuss the calculation of new profit sharing ratio in detail. 1. When gaining ratio or gain is not given, means old ratio is continued. When the ratio in which the retiring partner's share is to be distributed among the continuing partners is not given, it is assumed that the continuing partners will continue to share the profit or loss in their respective old profit and loss sharing ratio. It means their old ratio will become the new ratio. In this situation, new ratio of continuing partners becomes their old ratio by eliminating retiring partners' share. Illustration 1. M, N and O are the partners sharing profit and loss in the ratio of 4:3:2. Calculate new profit loss sharing ratio under the following circumstances. If 1. M retires, 2. N retires, 3. O retires. Answer. Old ratio of M, N and O is 4:3:2. 1. If M retires, new profit and loss sharing ratio between N and O will be 3:2. 2. If N retires, then new profit and loss sharing ratio of M and O will be 4:2, that is 2:1. 3. If O retires, then new profit and loss sharing ratio of M and N will be 4:3. Here, the gaining ratio will be the old ratio of partners. Gain is equals to new share minus old share. When M retires, M and O old ratio is 4:3:2. New ratio retired is to 3:2. N's gain is equals to 3/5 minus 3/9 is equals to 27 minus 15/45 is equals to 12/45. O's gain is equals to 2/5 minus 2/9 is equals to 18 minus 10/45 is equals to 8/45. Therefore, gaining ratio of N and O is equals to 12:8, that is 3:2. Similarly, when N retires, the gaining ratio of M and O will be 2:1, and when O retires, the gaining ratio of M and N will be 4:3. Illustration 2. A, B and C are the partners sharing profit and loss in the ratio of 1/2, 1/3 and 1/6 respectively. A. If A retires, B. If B retires, C. If C retires. Answer. A, B, C old ratio 1/2 is to 1/3 is to 1/6 is equals to 3/6 is to 2/6 is to 1/6, making denominator equal, is equals to 3:2:1. A. If A retires, then new profit loss sharing ratio of B and C will be 2:1 and gaining ratio also will be the same as 2:1. B. If B retires, then new profit loss sharing ratio of A and C will be 3:1 and gaining ratio also will be the same as 3:1. C. If C retires, then new profit loss sharing ratio of A and B will be 3:2 and gaining ratio also will be the same as 3:2. 2. When gaining share of the continuing partners is given. When gaining share of continuing partners is given out of the retiring partner's share, new profit and loss sharing ratio will be calculated as under. New share is equals to old share plus gain. Illustration 3. X, Y and Z are the partners sharing profit and loss in the ratio of 3:2:1. Y retires as a partner. X gain 1/9 share and Z gains 2/9 share from the profit and loss share of Y. Calculate the new profit and loss sharing ratio of X and Z. Answer. Old ratio of X, Y and Z is equals to 3:2:1. X gains 1/9 share and Z gains 2/9 share from 2/6 share of Y. Therefore, gain of X is equals to 1/9 and gain of Z is equals to 2/9. Therefore, gaining ratio is 1:2. New share is equals to old share plus gain. Therefore, X new share is equals to 3/6 plus 1/9 is equals to 9/18 plus 2/18 is equals to 11/18. Z's new share is equals to 1/6 plus 2/9 is equals to 3/18 plus 4/18 is equals to 7/18. Therefore, new profit and loss sharing ratio of X and Z is equals to 11:7. 3. When gaining ratio of the continuing partners is given. When the gaining ratio of continuing partners is given to distribute profit and loss share of the retiring partner, new profit and loss sharing ratio can be calculated as under. First of all, calculate gaining share of continuing partners by distributing retiring partner's share. Gaining share of continuing partner is equals to share of the retiring partner into gaining share given to the respective partners. Example, A, B and C are the partners sharing profit and losses in the ratio of 3:2:1. A retires and his share is distributed between B and C in the ratio of 1:4. A's share is equals to 3/6. A's 3/6 share will be distributed by B and C in the ratio of 1:4. So, B's gain is equals to 3/6 into 1/5 is equals to 3/30. C's gain is equals to 3/6 into 4/5 is equals to 12/30. So, gaining ratio of B and C is equals to 1:4. Thereafter, new profit and loss sharing ratio of B and C will be calculated as under. New share is equals to old share plus gain. Therefore, B's new share is equals to 2/6 plus 3/30 is equals to 10/30 plus 3/30 is equals to 13/30. C's new share is equals to 1/6 plus 12/30 is equals to 5/30 plus 12/30 is equals to 17/30. New profit and loss sharing ratio of B and C is equals to 13:17. Illustration 4. C, B and D are the partners sharing profit and loss in the ratio of 4:5:3. D retires and his share is taken up by C and B in the ratio of 2:1. Answer. Old ratio of C, B and D is equals to 4:5:3. Share of D is equals to 3/12, which will be received by C and B in the ratio of 2:1. Gain is equals to share of the retiring partner into share of gaining ratio. Therefore, gain of C is equals to 3/12 into 2/3 is equals to 6/36. Therefore, gain of B is equals to 3/12 into 1/3 is equals to 3/36. Therefore, gaining ratio of C and B is equals to 6/36 is to 3/36 is equals to 6:3 is equals to 2:1. New share is equals to old share plus gain. Therefore, new share of C is equals to 4/12 plus 6/36 is equals to 12 plus 6/36 is equals to 18/36. Therefore, new share of B is equals to 5/12 plus 3/36 is equals to 15 plus 3/36 is equals to 18/36. Therefore, new profit loss sharing ratio of C and B is equals to 18/36 plus 18/36 is equals to 18:18 is equals to 1:1. Illustration 5. M, N and C are the partners sharing profit and loss in the ratio of 1/3, 1/2 and 1/6. C retires and his share is taken up by M. Calculate the new ratio of profit and loss sharing of M and N. Answer. Old sharing ratio of M, N and C is equals to 1/3 is to 1/2 is to 1/6 is equals to 2/6 is to 3/6 is to 1/6. C retires and his 1/6 share is taken by M. Therefore, M's gain is equals to 1/6 and N's gain is equals to 0. New share is equals to old share plus gain. Therefore, M's new share is equals to 2/6 plus 1/6 is equals to 3/6. N's new share is equals to 3/6 plus 0 is equals to 3/6. Therefore, new profit and loss sharing ratio of M and N is equals to 3:3 means 1:1. When old and new profit and loss sharing ratios are given, gain is equals to new share minus old share. Illustration 6. U, P and A are the partners sharing profits and losses in the ratio of 4:3:2. U retires and P and A decides to share the future profit and loss in the ratio of 2:1. Calculate the gaining ratio of P and A. Answer. Old sharing ratio of U, P and A is equals to 4:3:2. U retires. New sharing ratio of P and E is equals to 2:1. gain is equals to new share minus old share. Therefore, P's new share is equals to 2 by 3 minus 3 by 9 is equals to 6 minus 3 by 9 is equals to 3 by 9. A's new share is equals to 1 by 3 minus 2 by 9 is equals to 3 minus 2 by 9 is equals to 1 by 9. Therefore, gaining ratio of P and A is equals to 3:1. 5. Accounting treatment of goodwill. On the death or retirement of a partner, the continuing partners receive profit and loss share of the retiring or deceased partner. To compensate this gain in profit, continuing partners give the retiring partner his share in firm's goodwill. Deceased or retiring partner is also entitled to receive his share in the firm's goodwill because the goodwill was earned by the firm when he was a partner. As per the Accounting Standard 26, only that goodwill for which consideration is paid can be recorded in the books of accounts. Internally generated goodwill cannot be recorded in the books of accounts. At the time of the retirement of a partner, also the goodwill of the firm is valued by internal assessment only. Therefore, no goodwill can be shown in the balance sheet of the firm as an asset. Therefore, retiring or deceased partner will be given his share in the firm's goodwill by the continuing partners in their gaining ratio by making necessary adjustments only in capital accounts of the partners. Old goodwill, if any, appearing in the old balance sheet should be written off by debiting all the partners' capital accounts in their old profit sharing ratio because the old partnership is dissolved. 1. Old goodwill, if any, appearing in the balance sheet of the old firm, it will be written off in old profit loss sharing ratio among all the partners including the deceased or retiring partner, for which following journal entry is passed. All partners capital or current account debit to goodwill account, being old goodwill written off among all the partners in their old profit loss sharing ratio. 2. Retiring or deceased partner is given his share in goodwill in their gaining ratio. Continuing partners capital or current account debit to retiring or deceased partners capital account, being goodwill given by the continuing partners to the retiring or deceased partner in their gaining ratio. Illustration 7. I, C, W and A are the partners sharing profit and loss in the ratio of 4:3:2:1. I retired from 1st April 2016. Balance sheet of the firm shows goodwill at Rs 20,000 at the time of the retirement of I. New profit loss sharing ratio of C, W and A was decided at 2:2:1. Goodwill of the firm valued at Rs 60,000 at the time of retirement of I. Write journal entry for goodwill. Answer: journal entries, date, particulars, ledger folio, debit rupees, credit rupees. 1st April 2016, I's capital account debit 8,000, C's capital account debit 6,000, W's capital account debit 4,000, A's capital account debit 2,000 to goodwill account 20,000. Being existing goodwill written off in old ratio. 1st April 2016, C's capital account debit 6,000, W's capital account debit 12,000, A's capital account debit 6,000 to I's capital account 24,000. Being I's share of goodwill adjusted to C's, W's and A's capital account in their gaining ratio. Explanation 1. Gaining ratio, old profit and loss sharing ratio of I, C, W and A is equals to 4:3:2:1. New profit and loss sharing ratio of C, W and A is equals to 2:2:1. Gain is equals to new share minus old share. C's gain is equals to 2 by 5 minus 3 by 10 is equals to 1 by 10. W's gain is equals to 2 by 5 minus 2 by 10 is equals to 2 by 10. A's gain is equals to 1 by 5 minus 1 by 10 is equals to 1 by 10. Therefore, gaining ratio of C, W and A is equals to 1:2:1. 2. I's share in goodwill is equals to 60,000 into 4 by 10 is equals to Rs 24,000. I's share of goodwill will be given by C, W and A in their gaining ratio 1:2:1. Goodwill given by C is equals to Rs 24,000 into 1 by 4 is equals to Rs 6,000. Goodwill given by W is equals to Rs 24,000 into 2 by 4 is equals to Rs 12,000. Goodwill given by A is equals to rupees 24,000 into 1 by 4 is equals to rupees 6,000. 6. Revaluation of assets and liabilities. Fixed assets are not shown at their market value in the books of the firm. Therefore, there is difference between their book value and the market value. Some assets, liabilities, and necessary provisions may not have been shown in the books. All profits and losses of the firm till the date of the retirement or death of a partner must be distributed among all the partners in their old profit-loss sharing ratio so that any partner may not get undue advantage or loss. Therefore, assets and liabilities are revalued at the time of the retirement or death of a partner, and net increase or decrease in them is transferred to the revaluation account. Net profit or net loss of revaluation account is distributed among all the partners in their old profit-loss sharing ratio. Increase in assets and decrease in liabilities and provisions is credited to the revaluation account. Decrease in assets and increase in liabilities and provisions is debited to the revaluation account. Net profit or loss of revaluation account is distributed among all the partners in their old profit sharing ratio in their capital or current account. Assets and liabilities will be shown in the new balance sheet at their new values. Memorandum Revaluation Account. Partners may also decide to show all the assets and liabilities at the same value in the new balance sheet after retirement. Memorandum Revaluation Account is prepared in such case. Net increase or decrease in assets and liabilities are recorded in the first part of Memorandum Revaluation Account in the same manner as they are shown in the revaluation account, and net profit or net loss is distributed among all the partners in their old profit-loss sharing ratio. In the second part of the Memorandum Revaluation Account, all entries of the first part are reversed, and therefore net profit of first part will become net loss, and net loss of first part will become net profit of the second part, which is distributed among the continuing partners except the retiring partners in their new profit-loss sharing ratio. All assets except cash and all liabilities will be shown in new balance sheet at their old values when Memorandum Revaluation Account is prepared. 7. Distribution of reserves and accumulated profit losses. Balances of reserves, undistributed profit or loss, and balances of deferred revenue, expenditure on the date of retirement or death are distributed among all the partners, including retiring or deceased partner in their old profit-loss sharing ratio. 8. Determination of amount payable to the retiring partner. Amount payable to the retiring partner is decided by preparing his capital account. 1. Following amounts are credited to the retiring partner's capital account. 1. Opening balance of capital account and credit balance of current account on the date of retirement. 2. Share in profit of revaluation account. 3. Share in reserves and undistributed profit. 4. Share in new value of goodwill. 5. Share in profit of the firm from the date of last balance sheet to the date of retirement. 6. Salary, commission, interest on capital, interest on loan given to the firm from the date of last balance sheet to the date of retirement. That is, if rate of interest on the partner's loan is not given, interest is payable on the partner's loan at the rate of 6% per annum till the date of retirement. 2. Following balances reduce capital, therefore they are debited to his capital account. 1. Debit balance of current account. 2. Drawings. 3. Interest on drawings till the date of retirement. 4. Share in undistributed loss and deferred revenue expenditure, that is, fictitious assets. 5. Share in old goodwill appearing in the books of the firm. 6. Share in loss of revaluation account. 7. Loan given by the firm to the retiring partner. The balance obtained by closing the retiring partner's capital account is the amount payable to the retiring partner. The amount payable to the retiring partner is paid in cash fully or partly, and balance of the unpaid amount is transferred to his loan account, for which of the following entry is passed. Retiring partner's capital account debit to cash account to retiring partner's loan account. Interest payable to retiring partner's loan account. Unpaid amount out of the total amount payable to the retiring partner is transferred to his loan account. If the rate of interest payable on such loan is not mentioned in the partnership deed, the interest is payable at the rate of 6% per annum as per Indian Partnership Act 1932. Illustration 8. Rohit, Mohit and Virat are partners sharing profit and loss in the ratio 4:3:2. Balance sheet of the firm as on 31st March 2017 was as under. Balance sheet as on 31st March 2017. Liabilities amount, assets amount. Liabilities, capital accounts, Rohit 1,60,000, Mohit 96,000, Virat 80,000, total 3,36,000. Reserve fund 45,000, workman compensation reserve 13,500, partners loans, Rohit 10,000, Mohit 16,000. Total 26,000. Creditors 64,000. Total of liabilities 4,84,500. On asset side, Goodwill 36,000, land building 1,50,000, machinery 90,000, stock 85,000, debtors 60,000, less bad debts reserve 4,000, total 56,000, bank 63,000, advertisement campaign expenditure 4,500, total of asset side 4,84,500. Rohit retired on 1st April 2017. Terms of retirement are as under. 1. Value of land building is 1,80,000. 2. Value of machinery is to be reduced by Rs 15,000. 3. Provision for doubtful debts is to be kept at 10% on debtors. 4. Rupees 5,000 not payable to creditors. 5. Valuation of goodwill is Rs 1,80,000. 6. New profit loss sharing ratio of Mohit and Virat is 2:1. 7. Rupees 20,000 are to be paid to Rohit and balance will be kept as loan. Prepare revaluation account, partners' capital accounts and balance sheet after retirement. Answer. Necessary calculation. 1. First of all, old goodwill Rs 36,000 is written off between old partners in their old ratio 4:3:2. Rohit's capital account debit 16,000, Mohit's capital account debit 12,000, Virat's capital account debit 8,000. To goodwill account 36,000. 2. Gaining ratio, old ratio of Rohit, Mohit and Virat is equals to 4:3:2. New ratio of Mohit and Virat is equals to 2:1. Gain is equals to new share minus old share. Gain of Mohit is equals to 2/3 minus 3/9 is equals to 6 minus 3/9 is equals to 3/9. Gain of Virat is equals to 1/3 minus 2/9 is equals to 3 minus 2/9 is equals to 1/9. Gaining ratio of Mohit and Virat is equals to 3/9 is to 1/9 is equals to 3:1. 3. Goodwill. Share of goodwill of Rohit is equals to Rs 1,80,000 into 4/9 is equals to Rs 80,000, which is given by Mohit and Virat in their gaining ratio 3:1. Therefore, goodwill payable by Mohit is equals to Rs 80,000 into 3/4 is equals to Rs 60,000. Therefore, goodwill payable by Virat is equals to Rs 80,000 into 1/4 is equals to Rs 20,000. Mohit capital account debit 60,000, Virat's capital account debit 20,000, to Rohit's capital account 80,000. Revaluation account. On debit side, particulars amount to machinery account 15,000, to bad debts reserve account 2,000, to capital accounts profit 4:3:2. Rohit 8,000, Mohit 6,000, Virat 4,000. Total 18,000. Total of debit side 35,000. On credit side, particulars amount by land building 30,000, by creditors account 5,000. Total of credit side 35,000. Partners capital accounts on debit side, particulars Rohit amount, Mohit amount, Virat amount. To goodwill account 16,000, 12,000, 8,000. To advertisement campaign expenditure account 2,000, 1,500, 1,000. To Rohit's capital account, that is goodwill, Mohit 60,000, Virat 20,000. To bank account, Rohit 20,000. To Rohit's loan account 2,46,000. To balance carried down, Mohit 48,000, Virat 68,000. Total of debit side, Rohit 2,84,000, Mohit 1,21,500, Virat 97,000. On credit side, by balance brought down 1,60,000, 96,000, 80,000. By reserve fund 20,000, 15,000, 10,000. By workman compensation reserve 6,000, 4,500, 3,000. By revaluation account profit 8,000, 6,000, 4,000. By Mohit's capital account Goodwill Rohit 60,000. By Virat's capital account Goodwill Rohit 20,000. By Rohit's loan account Rohit 10,000. Total of credit side Rohit 2,84,000, Mohit 1,21,500, Virat 97,000. Bank account. On debit side, particulars amount to balance brought down 63,000. Total of debit side 63,000. On credit side, particulars amount by Rohit's capital account 20,000. By balance carried down 43,000. Total of credit side 63,000. Balance sheet as on 1st April 2017 after retirement of Rohit. Capital liabilities amount. Capital accounts Mohit 48,000, Virat 68,000. Total 1,16,000. Mohit's loan 16,000. Creditors 59,000. Rohit's loan 2,46,000. Total 4,37,000. Assets receivables amount. Land building 1,80,000, machinery 75,000, stock 85,000, debtors 60,000, less bad debts reserve 6,000, total 54,000, bank 43,000, total of assets receivables 4,37,000. Illustration 9. Ajay, Alpa and Amay are the partners of the firm sharing profit and loss in the ratio of 50%, 30% and 20% respectively. The balance sheet of the firm as on 31st March 2017 was as under. Balance sheet. On liability side, capital accounts Ajay 60,000, Alpa 50,000, Amay 80,000. Total 1,90,000. Investment fluctuation fund 20,000. Workman compensation reserve 30,000. Creditors 40,000. Provident fund 60,000. Total 3,40,000. On asset side, goodwill 50,000, other fixed assets 1 lakh, investments 60,000, debtors 70,000, less bad debts reserve 6,000, total 64,000, stock 20,000, cash 16,000, profit and loss account 30,000. Total of assets 3,40,000. Ajay retires on 1st April 2017 on the following terms. 1. The claim of workman compensation is accepted at Rs 20,000. 2. The market value of investment is Rs 45,000. 3. Bad debts on debtors Rs 2,000 is to be written off and the provision for doubtful debts is to be kept 5%. 4. Fixed assets to be appreciated by 20%. 5. The book value of stock is overvalued by Rs 600 compared to its cost. The cost of stock is to be recorded. 6. The value of goodwill of the firm is Rs 1 lakh. 7. Ajay is to be paid Rs 10,000 in cash. 8. The new profit and loss sharing ratio of Alpa and Amay is 1:4. Prepare revaluation account, capital accounts of partners and the balance sheet after the retirement of Ajay. Answer. Revaluation account. On debit side, particulars amount to stock account 600, to partners capital account profit Ajay 10,000, Alpa 6,000, Amay 4,000. Total 20,000. Total of debit side 20,600. On credit side, particulars amount by bad debts reserve account Rs 6,000 minus bad debts Rs 2,000 minus new bad debt reserve Rs 3,400 is 600. By fixed assets account 20,000. Total of debit side 20,600. Partners capital accounts. On debit side, particulars Ajay, Alpa, Amay. To goodwill account 25,000, 15,000, 10,000. To profit loss account 15,000, 9,000, 6,000. To Ajay's capital account Goodwill, Amay 50,000. To Alpa's capital account Goodwill, Amay 10,000. To cash account Ajay 10,000. To Ajay's loan account Ajay 77,500. To balance carried down Alpa 46,500. Amay 11,000. Total of debit side 1,27,500, 70,500, 87,000. On credit side, particulars Ajay, Alpa, Amay. By balance brought down 60,000, 50,000, 80,000. By workman compensation reserve account 5,000, 3,000, 2,000. By investment fluctuation fund account 2,500, 1,500, 1,000. By Amay's capital account Goodwill Ajay 50,000, Alpa 10,000. By revaluation account 10,000, 6,000, 4,000. Total of credit side 1,27,000, 70,500, 87,000. Balance sheet as on 1st April 2017 after retirement. Liabilities amount, assets amount. On liability side, capital accounts Alpa 46,500, Amay 11,000, total 57,500, Ajay's loan 77,500, workman compensation claim 20,000, creditors 40,000, provident fund 60,000, total of liabilities 2,55,000. On asset side, fixed assets 1,20,000, investments 45,000, debtors 70,000, less bad debts 2,000, total 68,000, less bad debts reserve 5%, 3,400, total 64,600. Stock 19,400, cash rupees 16,000 minus rupees 10,000, payment to Ajay total 6,000, total of assets 2,55,000. Explanation 1. Gaining ratio. Old profit and loss sharing ratio of Ajay, Alpa and Amay is equals to 5:3:2. New profit and loss sharing ratio of Alpa and Amay is equals to 1:4. Gain is equals to new share minus old share. Alpa's gain is equals to 1/5 minus 3/10 is equals to 2 minus 3/10 is equals to minus 1/10. Sacrifice. Amay's gain is equals to 4/5 minus 2/10 is equals to 8 minus 2/10 is equals to 6/10. 2. Calculation of goodwill. Ajay is retiring, so goodwill receivable by him is equals to 5/10 into 1 lakh is equals to 50,000. Alpa's sacrifice 1/10 share, therefore amount of goodwill receivable by her is equals to 1/10 into 1 lakh is equals to rupees 10,000. Amay is gaining, so goodwill contributed by him is equals to 6/10 into 1 lakh is equals to rupees 60,000. Journal entries. Date, particulars, ledger folio, debit amount, credit amount. Amay's capital account debit 60,000 to Ajay's capital account 50,000 to Alpa's capital account 10,000. Explanation. Retiring partner Ajay as well as Alpa from the continuing partners sacrifice their profit share and therefore they receive goodwill by their sacrifice while Amay gains, therefore he will give goodwill by his gain. Note 1. Decrease in the value of investment is rupees 15,000 while there is investment fluctuation fund against it and it is rupees 20,000. Therefore, the balance of investment fluctuation fund after writing off the decrease in investments rupees 15,000 is rupees 5,000 which is credited to all the partners' capital accounts in their old profit and loss sharing ratio. For these following journal entries passed. Investment fluctuation fund account debit 20,000 to investments account 15,000 to Ajay's capital account 2,500 to Alpa's capital account 1,500 to Amay's capital account 1,000. 2. Claim of workman compensation accepted is rupees 20,000 against the workman compensation reserve of rupees 30,000 and balance of reserve rupees 10,000 are distributed among all the partners in their old profit and loss sharing ratio. Workman compensation reserve account debit 30,000 to workman compensation claim account 20,000 to Ajay's capital account 5,000 to Alpa's capital account 3,000 to Amay's capital account 2,000. Illustration 10. Jaya, Mamta and Smruti are the partners sharing profit and loss in the ratio of 2 upon 5, 5 upon 10 and 1 upon 10, balance sheet of the firm as on 31st March 2016 was as under. Balance sheet as on 31st March 2016. Liabilities amount, assets amount. On liability side, creditors 90,000, general reserve 70,000, capital accounts Jaya 2 lakh, Mamta 1 lakh, Smruti 90,000, total 3 lakh 90,000. Current accounts Jaya 26,000, Mamta 14,000, total 40,000. Bad debts reserve 10,000. Total of liability side 6 lakhs. On asset side, assets amount Goodwill 30,000, building 2,82,000, machinery 1,45,000, investments 33,000, stock 20,000, debtors 50,000. Loan to Smruti 30,000. Current account Smruti 10,000. Total of asset side 6 lakhs. Smruti retired on 1st April 2016 as a partner. At the time of her retirement, partners decide that 1. Rupees 4,000 is outstanding for rent payable. 2. Interest on investment is receivable rupees 2,500. 3. Investments to be sold for rupees 35,000. 4. Goodwill of the firm is valued at rupees 2 lakh. 5. Jaya and Mamta will share future profit in the ratio of 1:1. Prepare necessary accounts and balance sheet after retirement. Answer. Necessary calculation. 1. Old goodwill rupees 30,000 is written off between old partners in their old ratio, that is 4:5:1. 2. Gaining ratio. Old ratio of Jaya, Mamta and Smruti is equals to 2 upon 5 is to 5 upon 10 is to 1 upon 10 is equals to 4 upon 10 is to 5 upon 10 is to 1 upon 10 is equals to 4:5:1. New ratio of Jaya and Mamta is equals to 1:1. Gain is equals to new share minus old share. Therefore, gain of Jaya is equals to 1 upon 2 minus 4 upon 10 is equals to 5 minus 4 upon 10 is equals to 1 upon 10. Therefore, gain of Mamta is equals to 1 upon 2 minus 5 upon 10 is equals to 5 minus 5 upon 10 is equals to 0. All gain goes to Jaya. 3. Goodwill. Goodwill receivable by Smruti rupees 2 lakh into 1 upon 10 is equals to rupees 20,000. Amount of goodwill of Smruti will be paid by Jaya because gain of Mamta is 0. Jaya's current account debit 20,000 to Smruti's current account 20,000. Revaluation account. On debit side, particulars amount to outstanding rent account 4,000, to current accounts profit 4:5:1, Jaya 200, Mamta 250, Smruti 50, total 500. Total of debit side 4,500. On credit side, particulars amount by receivable interest on investments account 2,500, by investments account profit 2,000, total of credit side 4,500. Partners capital accounts. On debit side, particulars Jaya amount, Mamta amount, Smruti amount. To Smruti's current account 15,950. To Smruti's loan account 74,050. To balance carried down Jaya 2 lakh, Mamta 1 lakh. Total of debit side Jaya rupees 2 lakh, Mamta rupees 1 lakh, Smruti rupees 90,000. On credit side, particulars Jaya rupees, Mamta rupees, Smruti rupees. By balance brought down 2 lakh, 1 lakh, 90,000. Total of credit side 2 lakh, 1 lakh, 90,000. Partners current accounts. On debit side, particulars Jaya rupees, Mamta rupees, Smruti rupees. To balance brought down Smruti 10,000. To goodwill account 12,000, 15,000, 3,000. To Smruti's current account Jaya 20,000. To Smruti's loan account 30,000. To balance carried down Jaya 22,200, Mamta 34,250. Total of debit side Jaya 54,200, Mamta 49,250, Smruti 43,000. On credit side, particulars Jaya rupees, Mamta rupees, Smruti rupees. By balance brought down 26,000, 14,000. By general reserve account 28,000, 35,000, 7,000. By Jaya's current account 20,000. By revaluation account, profit 200, 250, 50. By Smriti's capital account, 15,950. Total of credit side 54,200, 49,250, 43,000. Balance sheet as on 1st April 2016 after retirement of Smriti. Capital liabilities amount. On capital liability side, capital accounts Jaya 2 lakh, Mamta 1 lakh, total 3 lakh. Current accounts Jaya 22,200, Mamta 34,250, total 56,450. Smriti's loan 74,050, creditors 90,000, outstanding rent 4,000, bad debt reserve 10,000, total of capital liabilities 5,34,500. Assets receivables amount. On assets receivable side, building 2,82,000, machinery 1,45,000, stock 20,000, debtors 50,000, receivable interest on investments 2,500, cash bank, that is sale of investments 35,000, total of assets receivable 5,34,500. Illustration 11. A, B and C are the partners of the firm sharing profit and loss in equal proportion. A retires as on 1st April 2014 after adjustment of goodwill, revaluation, profit and reserves. Balance of A's capital is Rs 90,000. Amount due to A is to be paid in 3 equal annual installments together with interest at 10% per annum. Prepare A's loan account till it is finally paid. Financial year ends on 31st March. Answer. A's loan account. Debit, date, particulars, amount. Credit, date, particulars, amount. On debit side, 31st March 2015 to bank account, that is 30,000 plus 9,000, total 39,000. To balance carry forward 60,000, total 99,000. 31st March 2016 to bank account, 30,000 plus 6,000, 36,000. To balance carried forward 30,000, total 66,000. 31st March 2017 to bank account, 30,000 plus 3,000, 33,000, total 33,000. On credit side, 1st April 2014 by A's capital account 90,000, 31st March 2015 by interest account 9,000, total 99,000. 1st April 2015 by balance brought down 60,000, 31st March 2016 by interest account 6,000, total 66,000. 1st April 2016 by balance brought down 30,000, 31st March 2017 by interest account 3,000, total 33,000. Adjustment of capitals 1. When the total capital of the new firm is given. Illustration 12. P, V and R are the partners of the firm sharing profit and loss in the ratio of 5:3:2. R retires after the adjustment of profit of revaluation, reserves and goodwill. Partners' capital stood Rs 50,000, Rs 70,000 and Rs 80,000 respectively. The entire capital of the firm as newly constituted is fixed Rs 1,40,000. Between P and V in their new profit loss sharing ratio 3:2. Calculate the actual cash to be paid or to be brought in by the continuing partners. Pass the necessary journal entries with working notes and also prepare capital accounts of partners. Answers. Explanation 1. Total new capital of P and V is equals to Rs 1,40,000 in proportion of 3:2. P's new capital is equals to Rs 1,40,000 into 3 by 5 is equals to Rs 84,000. V's new capital is equals to Rs 1,40,000 into 2 by 5 is equals to Rs 56,000. 2. Calculation of the amount of cash to be paid or to be brought in. New capital P's Rs 84,000, V's Rs 56,000 less actual capital after adjustment P's Rs 50,000, V's Rs 70,000. Capital to be brought in paid off. Total P's Rs 34,000, V's Rs 14,000. P's capital brought, V's capital paid. Rs 34,000 cash to be brought by P, Rs 14,000, additional cash withdrawn by V as capital. Journal entries. On debit side, capital accounts of partners. On debit side, particulars P, rupees, V rupees, R rupees. To R's loan account 80,000, to cash account 14,000, to balance carried forward P's rupees 84,000, V's rupees 56,000. Total of debit side 84,000, 70,000, 80,000. On credit side, particulars P's rupees, V's rupees, R's rupees. By balance brought down 50,000, 70,000, 80,000. By cash account P's rupees 34,000. Total of credit side 84,000, 70,000, 80,000. 2. When the total capital of the new firm is not given and the amount paid to the retiring partner is to be brought in by the remaining partners. Illustration 13. A, B and C are the partners sharing profit and loss in the ratio of 4:3:2 respectively. A retired on 1st April 2017. The capital of A, B and C after all the adjustment of the revaluation of profit, reserves and goodwill were at rupees 30,000, 80,000 and 90,000 respectively. All partners decide that A is to be paid amount due to him in cash which is to be brought in by B and C in such a way as to make their capitals proportionate to their new profit-loss sharing ratio. All necessary adjustments are to be made in cash. Give journal entries and prepare partner's capital account. Answer. Explanation 1. Capital of new firm. Old profit-loss sharing ratio of A, B and C is equals to 4:3:2. After retirement of A, the new ratio of B and C is equals to 3:2. Total capital of new firm. B's capital rupees 80,000, C's capital rupees 90,000, additional capital that is payable to A rupees 30,000. Total capital of new firm is rupees 2 lakh. B's share in total capital of new firm is equals to 2 lakh into 3/5 is equals to rupees 1,20,000, that is new ratio. C's share in total capital of new firm is equals to rupees 2 lakh into 2/5 is equals to rupees 80,000, that is new ratio. 2. Calculation of cash to be paid or brought in. Capital required after adjustments B's rupees 1,20,000, C's rupees 80,000, less actual capital after adjustment B's rupees 80,000, C's rupees 90,000. Cash to be brought in paid off B's rupees 40,000, C's rupees 10,000. B has capital brought and C has capital returned. Journal entries. Date, particulars, ledger folio, debit amount, credit amount. A's capital account debit 30,000 to cash account 30,000, being amount due to A paid off. Cash account debit 40,000 to B's capital account 40,000, being additional capital brought by B. C's capital account debit 10,000 to cash account 10,000, being additional capital of C paid off. Capital accounts of partners. On debit side, particulars A's rupees, B's rupees, C's rupees. To cash account A's rupees 30,000, to cash account C's rupees 10,000, to balance carried forward B's rupees 1,20,000, C's rupees 80,000. Total of debit side 30,000, 1,20,000, 90,000. On credit side, particulars A's rupees, B's rupees, C's rupees. By balance brought down 30,000, 80,000, 90,000. By cash account B's rupees 40,000. Total of credit side 30,000, 1,20,000, 90,000. 3. The retiring partner is to be paid in cash and an amount brought in by the remaining partner in cash in such a way that minimum cash is to be maintained. Illustration 14. Deep, Jyoti and Geeta are the partners sharing profit and loss in the ratio of their capitals. Balance sheet of their firm as on 31st March 2017 was as under. Balance sheet as on 31st March 2017. Capital liabilities amount, assets receivables amount. On capital liability side, capital accounts Deep 1 lakh, Jyoti 1,50,000, Geeta 1 lakh. Total 3,50,000. General reserve 28,000. Creditors 60,000. Provident fund 32,000. Total of capital liabilities 4,70,000. On assets receivables, Goodwill 14,000, land building 2,90,000, trademark 60,000, stock 50,000, debtors 40,000, less bad debt reserve 6,000, total 34,000, bank 22,000. Total assets and receivables 4,70,000. Jyoti retired on the above date. Partners decided that 1. New profit and loss sharing ratio of Deep and Geeta is to be kept at 1:1. Goodwill of the firm is valued at Rs 70,000. 2. Bad debt reserve on debtors is to be reduced up to 10%. 3. Stock is shown in the books at 25% more than its cost. Stock is to be recorded at cost. 4. Rs 60,000 is paid for trademark during current year, which is for total 6 years. 5. Liability of provident fund is decided at Rs 35,000. 6. Total capital of the new firm is to be kept as the total capital of the old firm. Deep, Geeta will maintain this capital in their new profit-loss sharing ratio. For this purpose, the difference is to be transferred to their current accounts. Prepare necessary accounts and balance sheet after retirement. Answer. Necessary calculations. 1. Gaining ratio. Deep, Jyoti and Geeta share profit and loss in the capital ratio, that is, old ratio is equals to 1 lakh is to 1,50,000 is to 1 lakh is equals to 10 is to 15 is to 10 is equals to 2 is to 3 is to 2. New ratio of Deep and Geeta is equals to 1:1. Gain is equals to new share minus old share. Therefore, gain of Deep is equals to 1/2 minus 2/7 is equals to 7 minus 2/14 is equals to 3/14. Therefore, gain of Geeta is equals to 1/2 minus 2/7 is equals to 7 minus 2/14 is equals to 3/14. Therefore, gaining ratio of Deep and Geeta is equals to 3/14 is to 3/14 is equals to 3:3, that is 1:1. 2. Goodwill. 1. First of all, old goodwill Rs 14,000 is written off between old partners in their old ratio 2:3:2. 2. New goodwill. Goodwill payable to Jyoti is equals to 70,000 into 3/7 is equals to 30,000. Goodwill payable by Deep is equals to 30,000 into 1/2 is equals to 15,000. Goodwill payable by Geeta is equals to 30,000 into 1/2 is equals to 15,000. 3. Stock is shown at 25% more than its cost. Suppose cost of stock is equals to 100 plus 25% more value, that is 25. Therefore, book value is equals to 125. Book value 125. On that, cost price 100. If book value is 50,000, then cost price is how much? Is equals to 50,000 into 100 divided by 125 is equals to 40,000. Therefore, difference amount 10,000, that is 50,000 minus 40,000, will be shown on debit side of revaluation account. Revaluation account. On debit side, particulars amount to stock account 10,000, to trademark account written off 10,000, to liability of provident fund account 3,000. Total of debit side 23,000. On credit side, particulars amount by bad debt reserve account 2,000, by capital accounts, that is loss 2:3:2, Deep 6,000, Jyoti 9,000, Geeta 6,000, total 21,000. Total of credit side 23,000. Partners capital accounts. On debit side, particulars Deep amount, Jyoti amount, Geeta amount. To goodwill account 4,000, 6,000, 4,000. To revaluation account loss 6,000, 9,000, 6,000. To Jyoti's capital account goodwill Deep 15,000, Geeta 15,000. To Jyoti's loan account Jyoti 1,77,000. To balance carried down Deep 1,75,000, Geeta 1,75,000. Total of debit side 2 lakh, 1,92,000, 2 lakh. On credit side, particulars Deep rupees, Jyoti rupees, Geeta rupees. By balance brought down 1 lakh, 1,50,000, 1 lakh. By general reserve 8 lakh, 12,000, 8,000. By Deep's capital account goodwill Jyoti 15,000. By Geeta's capital account goodwill 15,000. By current account difference Deep 92,000, Geeta 92,000. Total of credit side 2 lakh, 1,92,000, 2 lakh. Bank account. On debit side, particulars amount To balance brought down 22,000. Total of debit side 22,000. On credit side, by balance carried down 22,000. Total of credit side 22,000. Balance sheet as on 31st March 2017 after retirement of Jyoti. Capital liabilities amount, assets receivables amount. On capital liability side, capital accounts Deep 1,75,000, Geeta 1,75,000, total 3,50,000. Creditors 60,000, Provident Fund 35,000, Jyoti's loan 1,77,000, total of capital liabilities 6,22,000. On assets receivable side, building 2,90,000, trademark 50,000, stock 40,000, debtors 40,000, less bad debt reserve 4,000, total 36,000, bank 22,000, current accounts Deep 92,000, Geeta 92,000, total 1,84,000, total of assets receivable 6,22,000. Illustration 15. P, Q and R are partners in a firm sharing profit and loss equally. Balance sheet of their firm as on 31st March 2016 was as under. Balance sheet. Liabilities amount, assets amount. On liability side, capital accounts P 9,000, Q 6,000, R 6,000, total 21,000. General reserve 1,200, investment fluctuation fund 360, creditors 4,600, total of liabilities 27,160. On asset side, trademark 5,400, land building 10,000, X Limited's share 1,500, stock 3,000, debtors 3,000, less bad debt reserve 240, total 2,760, cash bank 1,500, profit loss account 3,000, total of assets 27,160. Are retired on 31st March 2016. Following terms were decided at the time of retirement. 1. Goodwill is to be valued at 3 times the average profit of last 5 years. 2. Value of land and building is Rs 15,000. 3. Market value of X Limited's share is Rs 1,200. 4. All debtors are good. 5. A provision of Rs 2,000 for outstanding salary is to be made. 6. Last 4 years profit of the firm was as under. 2011-12 Rs 6,000. 2012-13 Rs 2,000. 2013-14 Rs 3,000. 2014-15 Rs 2,000. 7. Share of R will be gained by P. 8. Amount due to R is to be paid in cash, which is brought in by P and Q in such a way as to make their capitals in proportionate to their new profit and loss sharing ratio. Prepare necessary accounts and new balance sheet. Answer. Revaluation account. Debit, credit, particulars, amount, particulars, amount. On debit side, to outstanding salary account 2,000, to partners capital account profit P 1,080, Q 1,080, R 1,080. Total 3,240. Total of debit side 5,240. On credit side, by bad debts reserve account 240, by land building account 5,000, total of credit side 5,240. Capital accounts of partners. On debit side, particulars P's rupees, Q rupees, R rupees. To profit and loss account 1,000, 1,000, 1,000. To R's capital account P's rupees 2,000. To cash bank account R's rupees 8,500. To balance brought down P's rupees 15,000, Q's rupees 7,500. Total of debit side P's 18,000, Q's 8,500, R's 9,500. On credit side, by balance brought down 9,000, 6,000, 6,000. By general reserve account 400, 400, 400. By investment fluctuation fund 20, 20, 20. By P's capital account Goodwill R's rupees 2,000. By revaluation account 1,080, 1,080, 1,080. By cash bank account P is rupees 7,500, Q is rupees 1,000. Total of credit side, P is rupees 18,000, Q is rupees 8,500, R is rupees 9,500. Cash bank account. Debit, particulars amount, credit, particulars amount. On debit side, to balance brought down 1,500, to P's capital account 7,500, to Q's capital account 1,000, total of debit side 10,000. On credit side, by R's capital account 8,500, by balance carried down 1,500, total of credit side 10,000. Balance sheet as on 1st April 2016 after retirement. Liabilities amount, assets amount. On liability side, capital accounts P 15,000, Q 7,500, total 22,500. Creditors 4,600, outstanding salary 2,000, total of liabilities 29,100. On asset side, land building 15,000, X Limited's share 1,200, stock 3,000, debtors 3,000, cash bank 1,500, trademark 5,400, total of assets 29,100. Explanation. 1. Valuation and distribution of goodwill. Average profit is equals to 6,000 plus 2,000 plus 3,000 plus 2,000 minus 3,000 whole divided by 5 is equals to rupees 2,000. Goodwill is equals to rupees 2,000 into 3 is equals to rupees 6,000. R's share in goodwill is equals to 6,000 into 1 by 3 is equals to rupees 2,000. Therefore, R's share of profit is to be transferred to P. Therefore, P gives goodwill to R. Journal entries. P's capital account debit 2,000 to R's capital account 2,000. 2. New profit loss sharing ratio. Old sharing ratio of P, Q and R is equals to 1:1:1. R retires and his share is gained by P. New share is equals to old share plus gain. Therefore, P's share is equals to 1 by 3 plus 1 by 3 is equals to 2 by 3. Q's share is equals to 1 by 3 plus 0 is equals to 1 by 3. Therefore, new profit loss sharing ratio is 2:1. 3. New capital of P and Q. P's capital is rupees 10,500 minus rupees 3,000 is equals to rupees 7,500. Add Q's capital rupees 7,500 minus rupees 10,000 is equals to rupees 6,500. Add paid to R, that is additional capital, is equals to rupees 8,500. Total capital of new firm is equals to rupees 22,500. Therefore, new capital of P is equals to 22,500 into 2 by 3 is equals to rupees 15,000. New capital of Q is equals to 22,500 into 1 by 3 is equals to rupees 7,500. Illustration 16. E, M and I are partners sharing profit and loss in the ratio of 5:3:2. Balance sheet their firm as on 31st March 2017 was as under. Balance sheet as on 31st March 2017. Liabilities amount, assets amount. On liability side, capital accounts E 60,000, M 30,000, I 50,000. Total 1,40,000. Reserve fund 50,000. Workman profit sharing fund 30,000. Creditors 70,000. Total of liabilities 2,90,000. On asset side, building 1,20,000. Machinery 80,000. Stock 30,000. Debtors 40,000. Less bad debts reserve 2,000. Total 38,000. Cash 22,000. Total of assets 2,90,000. I retired on 31st March 2017. Conditions of retirement were as under. 1. I's profit share will be gained by E and M in the ratio of 2:3. 2. Goodwill of the firm is valued at rupees 1 lakh. 3. Bad debt reserve on debtors is to be increased by 10%. 4. Building is valued at 110%. 5. Value of machinery is to be reduced by 10%. 6. Annual insurance premium of rupees 24,000 is paid for the year ended on 30th June 2017. 7. E and M will maintain total capital of the firm rupees 1 lakh in their new profit and loss sharing ratio after retirement of I. Prepare necessary accounts and balance sheet after retirement. Answer. Necessary calculation. 1. Gaining ratio. Old ratio of E, M and I is 5:3:2. I retired on 31st March 2017. His profit share will be gained by E and M in the ratio of 2:3. Therefore, gain of E is equals to 2/10 into 2/5 is equals to 4/50. Therefore, gain of M is equals to 2/10 into 3/5 is equals to 6/50. Therefore, gaining ratio of E and M is equals to 4/50 is to 6/50 is equals to 4:6, that is 2:3. New share is equals to old share plus gain. Therefore, new share of E is equals to 5/10 plus 4/50 is equals to 25 plus 4/50 is equals to 29/50. Therefore, new share of M is equals to 3/10 plus 6/50 is equals to 15 plus 6/50 is equals to 21/50. Therefore, new profit loss sharing ratio of E and M is 29:21. 2. Goodwill. Share of goodwill of I is equals to rupees 1 lakh into 2/10 is equals to rupees 20,000, which is given by E and M in their gaining ratio of 2:3. Therefore, goodwill payable by E is equals to 20,000 into 2/5 is equals to rupees 8,000. Therefore, goodwill payable by M is equals to rupees 20,000 into 3/5 is equals to rupees 12,000. E's capital account debit 8,000, M's capital account debit 12,000, to I's capital account 20,000. 3. Capital of new firm of rupees 1 lakh will maintain in the new profit loss sharing ratio of 29:21. Therefore, new capital of E is equals to rupees 1 lakh into 29/50 is equals to 58,000. Therefore, new capital of M is equals to rupees 1 lakh into 21/50 is equals to 42,000. Revaluation account. Debit particulars amount, credit particulars amount. On debit side, to bad debt reserve account 4,000, to machinery account 8,000, to capital account profit 5:3:2, E 3,000, M 1,800, I 1,200, total 6,000. Total of debit side 18,000. On credit side, by building account 12,000, by prepaid insurance premium 6,000, total of credit side 18,000. Cash account. Debit particulars amount, credit particulars amount. On debit side, to balance brought down 22,000, to M's capital account 7,200, total of debit side 29,200. On credit side, by E's capital account 22,000, by balance carried down 7,200, total of credit side 29,200. Partners capital accounts. Debit particulars E rupees, M rupees, I rupees. To I's capital account, goodwill E 8,000, M 12,000. To I's loan account, I 81,200. To cash account, E 22,000. To balance carried down, E 58,000, M 42,000. Total of debit side, E 88,000, M 54,000, I 81,200. On credit side, particulars E rupees, M rupees, I rupees. By balance brought down 60,000, 30,000, 50,000. By reserve fund 25,000, 15,000, 10,000. By E's capital account goodwill I 8,000. By M's capital account goodwill I 12,000. By revaluation account profit 3,000, 1,800, 1,200. By cash account M 7,200. Total of credit side E 88,000, M 54,000, I 81,200. Balance sheet as on 31st March 2017 after retirement of I. Liabilities amount, assets amount. On liability side, capital accounts E 58,000, M 42,000, total 1 lakh. I's loan 81,200. Workmen profit sharing fund 30,000, creditors 70,000, total of liabilities 2,81,200. On asset side, building 1,32,000, machinery 72,000, debtors 40,000, less bad debt reserve 6,000, total 34,000. Stock 30,000, prepaid insurance premium 6,000, cash 7,200, total of assets 2,81,200. 9. Determination of amount payable to the deceased partner and payment to his executor. The retirement of a partner normally takes place at a planned date, but the death of partner may occur any time. When a partner dies, his heirs are entitled to receive the amount due to the deceased partner. The heirs of the deceased partner are also entitled to receive the share of profits of the firm from the beginning of the year to the date of death, interest on capital, salary, etc. as well. The heirs of the deceased partner are entitled to receive the following. 1. The amount standing to the credit of the deceased partner's capital account and current account. 2. His share of accumulated profits and reserves. 3. His share of profit of the revaluation account. 4. His share in the goodwill of the firm. 5. His share in profits of the firm from the beginning of the year to the date of death. 6. Interest on capital up to the date of his death if provided by the partnership deed. 7. His salary or commission up to the date of his death if provided by the partnership deed. 8. Loan given to the firm and its interest up to the date of his death. Following amounts are debited to his capital account. 1. Debit balance of current account. 2. His share in the loss of revaluation account. 3. His share in accumulated losses. 4. His share in deferred revenue expenditure. 5. His share in the old goodwill of the firm shown in the books of the firm. 6. His drawings. 7. Interest on drawings. 8. His share in the loss that may have occurred till the date of his death from the last balance sheet. The above adjustments are made in the capital account of the deceased partner, and thereafter the balance of the capital account is transferred to his executor's account. Deceased partner's capital account debit to deceased partner's executor's account. Profit share to the deceased partner. He is entitled to receive his share in profit of the firm from the beginning of the year to the date of death. If he dies during the year before year ends, his share in profit is calculated without calculating the profit for the year of death. Therefore, his share in profit from the beginning of the year till the date of death is calculated on the basis of the past profit or sales as follows. 1. On the basis of last year's profit. 2. On the basis of average profit of past few years. 3. On the basis of previous year's sales and profit. Example. A died on 30th June 2016. His share in profit is 1/5. Financial year ended on 31st March. Last 3 years profit is as under. 2013-14 rupees 80,000, 2014-15 rupees 60,000, 2015-16 rupees 40,000. Sales for the year 2015-16 amounted to rupees 2 lakh. Sales from the first 3 months of current year are rupees 60,000. Find out the deceased partner's share in the profit of the firm under following basis. 1. On the basis of last year's profit. 2. On the basis of average profit of last 3 years. 3. On the basis of last year's sales and profit. Answer. 1. On the basis of last year's profit. Profit share for the 3 months from 1st April 2016 to 30th June 2016 will be payable to A. Last year, 2015-16, profit is rupees 40,000. Share in profit of A, rupees 40,000 into 1/5 into 3/12 is equals to rupees 2,000. 2. On the basis of average profit of last 3 years, average profit is equals to 80,000 plus 60,000 plus 40,000 whole upon 3 is equals to rupees 60,000. A's share of profit is equals to rupees 60,000 into 1/5 into 3/12 is equals to rupees 3,000. 3. On the basis of last year's profit and sales. Sales of 2015-16 rupees 2 lakh, that is profit rupees 40,000. 3 months of 2016-17, sales rupees 60,000, then profit is how much? 40,000 into 60,000 divided by 2 lakh is equals to rupees 12,000. That is profit of the firm for 3 months. Profit share of B is equals to 12,000 into 1 by 5 is equals to rupees 2,400. B's share of profit is payable before accounting year ends. Following journal entry is passed to give profit share to B. Profit and loss suspense account debit to B's capital account. Other payments which affect profit like interest on capital, interest on loan, salary, commission, etc. are also transferred to the profit and loss suspense account. For this, journal entry will be 1. Interest on capital account debit, interest on loan account debit, salary account debit, commission account debit to deceased partner's capital account. 2. Profit and loss suspense account debit to interest on capital account, to interest on loan account, to salary account, to commission account. Deceased partner's capital account. Debit particulars amount, credit particulars amount. On debit side, to current account, debit balance, to revaluation account, share in loss of revaluation account, to profit and loss, accumulated losses, to goodwill account, written off, that is, share in old goodwill, to drawings account, to interest on drawings account, to advertisement campaign expenditure account, to profit and loss suspense account, share in loss till the date of death. Total of debit side. On credit side, by balance brought down, by current account, credit balance, by reserve account, share in reserve, by profit and loss account, share in accumulated profit, by revaluation account, share in profit, by other partners capital account, share in goodwill, by interest on capital account, by salary or commission account, by loan account given to firm, by interest on loan account, by profit and loss suspense account, share in profit till the date of death. Payment to deceased partner. Payment to the executors of deceased partner is made as provided in the partnership deed or as agreed by the remaining partners and the executors. The dues may be paid. Amount payable to the deceased partner is paid as under 1. Full in one installment. 2. In more than one installment. Following journal entries are passed when the payment is made as per above method. 1. Full amount is paid in one installment. Deceased partner's executor's account debit to bank account. 2. When payment is made in more than one installment, in this case, the executor is entitled to interest at 6% per annum unless agreed otherwise. As per Indian Partnership Act 1932, the executor has option to take the share of profit instead of interest. When installment with interest is paid, following journal entry will be passed. 1. When interest is due, interest account debit to deceased partner's executor's account. 2. When installment is paid including interest, deceased partner's executor's account debit to bank account. Illustration 17. X, Y and Z are the partners sharing profit and loss in the ratio of 5:3:2. Balance sheet of the firm as on 31st March 2016 was as under. Balance sheet, liabilities amount, assets amount. On liability side, capital accounts X 50,000, Y 80,000, Z 70,000. Total 2 lakh. General reserve 20,000. Creditors 30,000. Total of liabilities 2,50,000. On asset side, fixed capital 80,000, debtors 20,000, stock 80,000, cash 30,000, advertisement campaign expenditure 40,000, total of assets 2,50,000. Z died as on 31st March December 2016. The terms of partnership deed are as under. 1. Share of profit for the period from the closing of the last financial year to the date of death on the basis of the last year's profit to be given. 2. Goodwill of the firm is to be valued on the basis of twice the average of the past 3 years' profit. Profit of last 3 years was as under. 2013-14 rupees 80,000, 2014-15 rupees 70,000, 2015-16 rupees 60,000. Calculate amount payable to Z's executor by preparing his capital. Answer. Z's capital account debit particulars amount, credit, particulars amount. On debit side, to advertisement campaign expenditure 8,000 to Z's executors account 1,03,000, total of debit side 1,11,000. On credit side, by balance brought down 70,000, by general reserve account 4,000, by profit and loss suspense account share in profit 9,000, by X capital account goodwill 17,500, by Y's capital account goodwill 10,500. Total of liabilities 1,11,000. Explanation 1. Z's share in profit on the basis of last year 2015-16 profit from 1st April 2016 to till date of death 31st December 2016 for 9 months profit is payable to Z. Z's share in profit is equals to 60,000 into 2 by 10 into 9 by 12 is equals to rupees 9,000. 2. Valuation of goodwill and share of Z in goodwill. Average profit is equals to 80,000 plus 70,000 plus 60,000. Whole divided by 3 is equals to rupees 70,000. Goodwill of firm rupees 70,000 into 2 is equals to rupees 1,40,000. Z's goodwill is equals to rupees 1,40,000 into 2 by 10 is equals to rupees 28,000. X and Y will give goodwill to Z in their gaining ratio. Old ratio of X, Y and Z is equals to 5:3:2. Old ratio of X and Y is equals to gaining ratio is 5:3. Goodwill given by X rupees 28,000 into 5 by 8 is equals to rupees 17,500. Goodwill given by Y is equals to rupees 28,000 into 3 by 8 is equals to rupees 10,500. Illustration 18. Kamal, Bimal and Vimal are the partners sharing profit and loss in the ratio of 1:2:3. Their balance sheet shows following balances on 31st March 2016. Capital, Kamal, rupees 10,000, Bimal, rupees 20,000 and Vimal, rupees 30,000. General reserve, rupees 24,000. Loan of Vimal, rupees 10,000. Goodwill, rupees 12,000. Vimal died on 31st May 2016. Following conditions were provided in partnership deed. 1. Goodwill of the firm is to be valued at 2 years purchase of average profit of last 3 years. Profit of last 3 years was rupees 25,000, rupees 40,000 and rupees 25,000. 2. Profit share of the deceased partner till the date of death is to be decided on the basis of average profit of last 3 years. 3. Interest on capital is to be allowed at 12% per annum. Prepare Vimal's capital account. Answer. 1. First of all, old goodwill is written off in old ratio. Therefore, share of goodwill of Vimal is equals to rupees 12,000 into 3 by 6 is equals to rupees 6,000. Vimal's account debit 6,000 to goodwill account 6,000. 2. New goodwill. Average profit is equals to 25,000 plus 40,000 plus 25,000 whole divided by 3 is equals to 90,000 divided by 3 is equals to rupees 30,000. Goodwill of the firm rupees 30,000 into 2 is equals to rupees 60,000. Therefore, share of goodwill of Vimal is equals to rupees 60,000 into 3 by 6 is equals to rupees 30,000, which is given by Kamal and Bimal in their gaining ratio 1:2. 3. The share of Vimal in profit till the date of death. Vimal died on 31st May 2016. Profit share for 2 months from 1st April 2016 to 31st May 2016 will be receivable. Therefore, share in profit of Vimal is rupees 30,000 into 3 by 6 into 2 by 12 is equals to rupees 2,500. 4. Interest on capital. 12% interest on Vimal's capital for 2 months is equals to rupees 30,000 into 2 by 100 into 2 by 12 is equals to rupees 600. 5. Interest on loan. 6% interest on Vimal's loan for 2 months is equals to rupees 10,000 into 6 by 100 into 2 by 12 is equals to rupees 100. Vimal's capital account. Debit, date, particulars, ledger folio, amount, credit, date, particulars, ledger folio, amount. On debit side, 31st May 2016 to goodwill account old 6,000, 31st March 2016 To Vimal's loan account, closing balance 79,200. Total of debit side 85,200. On credit side, 31st May 2016, by balance brought down 30,000. 31st May 2016, by general reserve account 12,000. 31st May 2016, by Vimal's loan account 10,000. 31st May 2016, by interest on Vimal's loan account 100. 31st May 2016, by Kamal's capital account Goodwill 10,000. 31st May 2016, by Vimal's capital account Goodwill 20,000. 31st May 2016, by profit loss suspense account share in profit 2,500. 31st May 2016, by interest on capital account 600. Total of credit side 85,200.